There'll be some competition, but we went over there day one and built rapport with the agent, and he's gonna be writing our offer. It has an Ohana unit. It's has a 13,000 square foot lot. It has an ocean view. So I mean, we could CPR it, or I could. There's a couple of plays there potentially, but yeah, it's gonna be a competitive situation. So we'll see.
Yeah, 100%. So what are you gonna try to offer?
Probably somewhere in the mid 8s to low 8s.
Nice. That's what it takes these days. The mid 8s to get a fixer upper. That's it's a crazy world we live in right now. You're still doing the LA market too, right?
Yeah, I have 5 flips right now in LA.
Right on. Congratulations.
Oh boy. Hey, Alex, did you see my text regarding like scope of work and everything? I can have somebody out there Sunday.
Yeah, I'm just running my final numbers here. Just kind of, and then I'm gonna have another conversation with the agent, and then I'll be right back to you on that.
Perfect. Thank you.
Sweet. It's good stuff. I am working this through. Alex, anything, any good news today you want to share?
Just mainly. Oh, are you talking about Alex Young or me?
I could be either. Either of you've got good news. That's all good. We like it. Any lessons? Any lessons you're learning this week, Alex?
I think the main lesson I'm learning is you got to surround yourself with A players, people that extreme desire to be in this business, because otherwise you're just trying to convince people that are either not that motivated, or people that just don't get it, that don't understand what it takes to be successful in this business.
100%. That's really solid. They somebody once said that you are the average of the top 5 people you spend the most time with. So that would put me right between about a 13-year-old and a 14-year-old mentality. So we'll see what happens there. But it is so true. Who you surround yourself with is who encourages you, builds you up. Spent a couple of days with Alexander Young, and the guy is just so inspiring right now because he's going through this whole program where he's reprogramming his mindset. And so I just love it. It's great. You know, you get around people like that are trying to better themselves. It just is contagious to keep bettering one another. We maybe even, Alex and I are brainstorming. I'm just curious if anybody would be interested. So drop this in the chat. We were thinking of pulling together just really informally a mastermind on Oahu, maybe sometime 3rd or 4th week of April. We were thinking maybe just kind of all jumping on a sailboat or something like that and just cruising around for a bit, talking story, maybe just sharing some lessons and such like that. So if anyone thinks that sounds interesting, just drop in the chat that you're in or interested. You don't have to commit, and I don't think there's a price to it. Alexander Young might charge some money, but for me, it's like it'd be fun just to hang out and learn what everybody's learning and stuff. So that would be cool. Let us know. And
just to highlight that real quick, guys, we have I think one of the guests we'll be bringing is a huge land developer. He specializes in hillside development, and I just did a trip with him actually to New Mexico for development. He's going to do a minimum of at least 1,600 single family homes across 60 acres. And he'd be a good resource for us to kind of bounce things off of, especially for any of those more challenging projects. I don't know if Chris Watchendorf's on here, but I know he has one. And during this, we'll be going out to his project, and maybe we could take everybody to the project and have Tyler kind of take a look at it and break it down for us and do a walkthrough. But he owns a mountain essentially here in Las Vegas that he pretty much blew up and put in 49 flat lots.
That's awesome. Good stuff. Sweet. Roderick, welcome. Chris, welcome.
Aloha, everybody. You.
Roderick is on caffeine again. We love it.
Yeah.
You're just naturally energetic, right? Were you formerly a cheerleader?
Yeah, I was. Absolutely. Throwing girls up in the air. Tandem surfer. I'm a tandem surfer.
That could do it too, right? That's awesome. We love it. Well, glad that you're on. Chris, how are you doing, sir?
Super, man. How you doing?
We're doing well. We're doing well. I heard you got some cool projects coming up as well, so that's pretty exciting.
hopefully we could break ground. That's going to be exciting.
Yeah, tell us a little bit about the project you're thinking about right now. Your most exciting one.
It's just got 3 acres in Honolulu, and it's on a 70-foot decline. I don't want to say cliff, but it's pretty steep. So just try to grade it out and put another 8 houses in.
That's going to be exciting. We've got some resources for the steep, actually, so that's why we were talking about you. We got some ideas for you. So Alexander and I were brainstorming, but that's gonna be a great project.
It will be, and the end of my W-2. That's what I want.
The end of your W-2. That's what you want. Well, the good news is that Dan today is going to tell us all about that. So. It's going to be solid. In case some of you didn't get to hear, we brought on one of our favorite CPAs today. And then we have a couple that are based in Seattle who actually are doing the real estate professional status. So if you know of anybody that you want to have jump on this, shoot them the Zoom information here. We'll probably get started pretty quickly on that presentation. But if you've got a CPA or other investors or anybody you know who's in their W-2 job that they hate, this would be a good time just to tell them, hey, jump on. Hey, Alex, will you invite our Vegas team in case they didn't get the invite?
You got it.
Just so that way they can all be there. So anybody you know that's interested in real estate professional status, avoiding W-2 taxes, or figuring out how to embezzle money, no, forget the third one. The other 2 will be valid today. Should be cool. But let's just start off with a couple of what we start off with every week. I think Corey's on, but I'll take lead and Corey can jump in a minute. But anybody got what we typically every week just talk about, just leads? Anybody got any leads that anybody wants to share, or good deeds that kind of happen over the week that would be of interest to share with everybody? Leads, good deeds.
I got a good deed.
Sweet.
Daniel. Our boy Keone over there, the flipper. They sold a house recently on the west side, and they took like $50,000 less to put in some like a family that like a local family versus like an investor where they could get in the market just because they liked the cover letter and they liked the family who applied, so they had a good story. So just props to that guy, man. Just for, I guess, end of the day, I guess he took him and Richie, they took a big like cut. I mean, just to put in a local family that just had a really good story. So
that's awesome. Thanks for sharing that, Daniel. Keone, are you or Richie? I see Keone. He's blocked, meaning he's probably on the phone. But maybe he'll unmute himself in a minute. But that's a cool story. That's what we do. Is we don't.
What's up, everybody? Thank you, Daniel. Appreciate that, man.
Hey, tell us the story. What happened?
This was the one that we actually acquired off market, and we sold it off market, and we were getting a lot of traction, and we didn't even go to market, but we were getting a lot of feelers out there. And the story was the guys next door. They wanted to purchase the house from the beginning from us. And we just said, we're going to put it on the market, but we'll give you guys first dibs. And there was a bunch of people all on the same street that actually wanted to purchase this house because they didn't want outsiders to come in. It's a close-knit community. And we just honored our verbal agreement from the beginning, saying that, yeah, if you guys are still interested, once we get done with the house, we'll definitely entertain, you guys' offers. We're not sure where we're going to be at. But just so happened as we're going through the process, there's a bunch of houses that was selling super high. I mean, we were very conservative on the numbers, and then like down the street it's even higher. So yeah, long story short, I mean, like we definitely did leave money on the table, but like I shared with our group, it was just more than that. At the end of the day, I mean, like it wasn't just about the money. Obviously, this is a for-profit business, but we do put, like we practice what we preach, right? It's people before profits, and there's more than enough money in there. Obviously, we could have made more if we went to market, But the story with these guys, man, they just were super sincere. And I don't think I shared with my other group, but it was even more heartwarming because they've been trying to get a house for a while, a husband and wife couple. And then they added a little juice on there saying that, you know, we didn't even share with our family yet, but we are expecting our first child. I'm like, oh, come on, man. That's all in the feed. Super cool. So we congratulated them. And yeah, I mean, it just worked out, man. It's such a great story for us. And, you know, Richie and I share the same mindset. And I think that's what we get along, that we looked at each other and it's like, it's not about the money, man, because we are getting sought after and people are like throwing it down for us. And I'm like, no, we're good, man, you know, so.
Yeah. Right on. Applause to Keone and Richie. That's fantastic.
Yeah.
And of course, they got to throw in that curveball at the end. Yeah. So you're just like, oh, heart tug. Gotta.
Yeah. So we just had that talk with them, obviously, and that, you know, it would be awesome as long as you guys can stick with us, right? Like, you know, like there's no hiccups as far as the financing part, right? Because it was a conventional loan. So we were willing to take a chance with them. And they were willing to take a chance with us because we did have some holdups with the electrical stuff. So they were so fine because, again, their family lived right next door to the house. So they were watching it. All good, man. Yeah, all good.
I told him, that's too much of a discount. I mean, like maybe 20 grand, maybe 30 grand the most. 50 grand is too much, right? I wouldn't be able to give a friends and family discount for that much. So, but like next time, right? Next time you're selling the house, I told Keone, right? Get first dibs, right? I got my cover letter ready, so.
Daniel's not even pregnant, but he'll make a way.
And I think it was more, right? Like we didn't go to a market. We even consulted with Ashley, you know, I mean, like she was solid with us too. So she was telling us like, are you guys sure? Are you guys sure? And we're like, no, we're good, man. And she asked us multiple times, are you guys sure? Like, yeah, we're good. It's like, because the market was hot. I mean, it still is, but it was just on fire, man, when we were coming out. And same comps down the road was like super high. But again, all good, man. It made sense.
That's awesome. Well, what's going to be cool is to just listen to your story as you go into the future, because generosity always comes back with generosity tenfold. You know, I truly believe that. So it'll be really cool to just see how that comes back to you folks in terms of deals, or, I mean, your next deal with a profit margin that blows your mind away type of thing. It's just, you know, we don't give in order to get, but what's cool is generosity always creates more opportunity for blessings or more fortune or just more favor, you know, so keep that in mind, and then let us know kind of what seeds you planted today that are going to reap something awesome in the future.
For sure. Thanks for the.
We love it. We love it. Anybody else got any leads, or anybody got a need you got? I mean, if anybody got an investment opportunity that you're looking at that could be a great opportunity for somebody to jump into?
I have one.
Yay! Sounds good. Helena, what you got?
Well, I'm not really something that I have, but it's somebody that we're trying to help, my husband and I, and we're in the process of possibly starting a probate. So this property that was burned is now possibly going to be restored once he comes to money that he has in his accounts through the probate. So it is a long process, but in the meantime, we need to clean up the place because he's facing $100 a day fines if he doesn't clean up. So if someone could maybe give us, you know, maybe in the chat section, some company that will do a reasonable job to either clean up, I mean, demo and rebuild, or just clean up and salvage what's there. I'm not an expert, so I don't know how much can be salvaged. Is there like someone here, or maybe you know of, who could do a reasonable pricely project for us?
That's awesome. So if anybody on Oahu, Helena, you're on Oahu, right?
Yes.
So if anybody has somebody on Oahu that is a good demo crew or cleanup crew, or a company that you know of that you've worked with before for that type of work, drop it in the chat so Helena can grab it. And Helena, will you drop your email address in the chat? So that way, if anybody wants to just email you afterwards, they have that available as well. That'd be awesome.
I just wanted to mention that the house is on a slope on the side of a mountain. The road is almost like above the houses. Okay. So it is a little bit of a difficulty to access it. So anyway, thank you so much. Appreciate it.
No, that's great. Okay, appreciate that. Keep doing what you're doing. Anybody else got a need or a lead or a good deed, or anybody want to rat out somebody else who did a good deed this week?
I have a need, Kakoa.
Maria!
Yes, it's me.
Yeah,
Hello,
what's your need?
everyone.
You need coffee? You need lunch?
No, I don't need any of that. So I have a potential tenant looking for a place to lease in Madison area in Seattle. So if anyone have anything available, please let me know. Their budget is about $3,000 to $4,000 a month with pet.
Sounds great. If anybody wants to buy a house to lease out, you got a tenant ready to go for $3,000 to $4,000 a month. Perfect.
Thank you.
Love it. Anybody else? Alex, any investment opportunities, looking for some funding, private money that you want to talk about? Maybe Paw Springs?
Yeah, I mean, the developer that we were talking about we are going to bring out to Hawaii, actually, to look at Chris's property specifically. He has an extensive amount of deals going on right now. So I'm sure there will be an opportunity to do some investing with him. That would be one. Also, if anyone has any properties, which I know we were looking at a few that are waterfront, ideally under $1 million, that can be condos. We're going to look at one with Dustin and one with Richie and Keone's in Hawaii Kai. But any other ideas, if you guys have something available, I have a buyer that's looking to buy pretty much as soon as possible. He's not in a super rush, but he is on the market to buy right now. And then I'll have a few more private investment opportunities coming up in the next, I'd say, 2 months on different deals that we'll be able to deploy some money in. And ideally, they'll be in Las Vegas. So if you guys want to do a trip here, come check out the property. Good time to do it.
Love it. Sweet. Anybody else got any announcements or leads or needs or anything that you've got going on that other investors might be excited to hear about?
All right, I'll give one more shout out, just pretty much everybody in the entire group, guys. I'm grateful for any of you that have been inviting new members to our call, because we're stronger together. And I believe everyone in this group has the mentality of people over profits, and Keone and Richie just set a high example of doing that. And it's really special to see our group shining like that. And it's great to see emails and messages come in from new people that join and just say, we're so grateful for the opportunity to be in this call and to see everyone really helping each other, close deals and work together, because it's about all of us, being a rising tide and raising all ships. And I think that's one thing we really do here special. So thank you to everyone that's joining in our call and continues to be here.
It's awesome. Well, then let's just jump right into our guests. If anybody's got anybody you want to invite, feel free to do so, and we can add them in along the way. But one of the things that our team in Seattle has been working a lot with are high income, high net worth investors who have W-2 careers, and they're looking for opportunities to take some of that tax money that they give Uncle Sam and redirect it into investing in order to allow them to have a passive income portfolio. And IRS has been generous enough to provide a small opportunity called real estate professional designation. And a lot of folks have talked about it or heard about it. Sometimes it's just confusing as to what exactly does that mean, and how does it work, and how do we qualify, and what do we need to do in order to maintain it, and exactly how much taxes on our W-2 gets written off, so that way potentially we could have a tax-free year on our W-2 side while building up a passive income portfolio. So, I mean, I think if every one of us could raise our hands to say, hey, let's not pay taxes anymore, I think all our hands would go up and be like, yeah, that'd be cool. We don't want to pay income taxes. But, we want to do it legally. And today was great. We have an amazing guest with us, and he's one of the favorites when it comes to a CPA who knows what he's doing relative to real estate professional status and helping investors. He actually is also the accountant for Troy and Maria. And Troy and Maria actually are clients of ours from 2019. So before COVID hit, we actually got to hang out and we actually looked at properties together. And so we helped them get a multifamily property. And really, as they were starting their real estate professional status journey, we were able to help them think through some of what all that meant and how that would be tracked and how to do real estate in such a way to qualify for that real estate professional status. And so before we get to Dan, Troy, tell us a little bit about the benefits of real estate professional status in your family. You're formerly Disney executive, high income, loved real estate, and something that you were fascinated about, heard about real estate professional status. So just, we'll get to visit your story throughout this afternoon, but just high level to start, tell us a little bit of what real estate professional status has done for your family.
Yeah, I'll start there, but first a disclaimer. So my accountant is on the phone. So I'm not an accountant or an attorney, so I defer all accounting questions to Dan. And then my wife, Maria, we're actually in the same house, but we can't be in the same room because of echo purposes. So that's why we're completely separate. But anyway, no, I think it's been significant. And let me start off by saying that, you know, we've been working with Dan. I think this is our third or fourth year, right, Dan? And it really started with, you know, it was a recommendation through some, you know, colleagues that Kakoa and I and Maria have in common, and friends and colleagues. And it started off with, you know, just a conversation about where we were, about how much, you know, W-2 income that we generated. Maria at the time was a stay-at-home mom and managing the house and our rental properties. And then I, you know, worked a W-2 job. And so, you know, we met with Dan the first time and we opted for their, you know, tax strategy. And Dan has the numbers, but, you know, they work with a lot of real estate investors. And that's, you know, and I knew right away, based on the information that we had learned through some of the studying we've done and research we've done, et cetera, that Dan and his team actually, they knew what they were talking about. You'd say things like 1031 exchange or whatever, and he knew exactly what we were talking about. So we knew we were in the right hands. And I'll also say, and then I'll answer your question, Kakoa, that, you know, real estate professional status, and we had like a, I don't know, in our strategic plan, tax plan, there were like 10 or 11 recommendations that Dan and his team had made to us. And reps, or real estate professional status, was only one of those 10 or 12. One of the others was like 1031 exchanges. And so then there were like, you know, 8 or 9 other recommendations that help, you know, kind of, you know, offset income or kind of, you know, decrease your tax liability overall. So it wasn't just kind of a one-dimensional approach to tax savings. It was multidimensional. And some of the stuff, you know, it takes a while to get there and to implement it. And I will say that we've implemented some of it, but we still have a long ways to go to get it right. So anyway, to answer your question, yeah, I mean, it was significant for us. I mean, because Maria was a, you know, a stay-at-home mom and managing our, you know, some of our rental properties, you know, we were able to, you know, through some very specific documentation required by the IRS, we were able to, or she was able to claim real estate professional status, which is a IRS kind of tax designation that, you know, your accountant would make when you file your taxes. And, you know, among other things, what it does, and this is where I'm going to get a little over my head and I should turn it over to Dan, but it allows us to very simply put, kind of offset my W-2 income. Not all of it, of course. I mean, that would be the goal, but to offset a pretty significant portion of that. And so we went, and not to say, and Dan, you can comment on this later, but, you know, we literally went from working with one accountant that knew absolutely nothing about real estate investing and paying, you know, $10,000 to $20,000 a year in taxes, even though I was kind of claiming maximum, right? To essentially offsetting, you know, north of $100,000 of W-2 income and getting a pretty significant, you know, tax return in doing so. So, you know, some of that was, you know, clearly some of that was directly related to real estate professional status and some of the cost segregation studies that we had done on our properties. But there's some other things that kind of helped with it overall. But it's been pretty beneficial to us. And, you know, I think as long as it makes sense, as long as it's possible, we'll continue kind of with the due diligence to, you know, for Maria to claim rep status and continue offsetting W-2 income until I no longer have to rely on W-2 income. That is the goal. So anyway.
That's awesome. Well, good. We're going to get to hear more of your story, but just that teaser that you were able to offset $100,000 in taxes. I mean, that's not a small amount of taxes. And so it's very compelling and interesting for all of us. Now, if anybody on here is a realtor, this is something you want to take some notes on, because this will be a great opportunity to mentor some of your clients as they even buy their single family homes to consider, in addition to their single family home, looking at passive income properties, and if they've got that W-2, to see if they can offset some of that W-2 with that investing. And if you're an investor, this is such an amazing tool, especially if you're married. It gives you an opportunity, like with Troy and Maria. Maria claimed that status last year. Troy was the W-2 guy. So a great partnership team that saved $100,000 in taxes. Now, that's phenomenal. I mean, that's a lot of opportunity to buy passive income properties with that. So with that, the man behind the scenes, I guess if you'd say, in Troy's opinion, is Dan Nicholson, also by way of disclosure, as Troy said. Dan's LinkedIn is super funny. He claims himself as a not boring finance guy, helping purpose-driven entrepreneurs achieve financial certainty. So a not boring finance guy. So Dan, let's start off with that. So what makes you not boring?
Well, that's a good question. I'd like to believe it's several things, but my wife might have a different opinion than that. You know, I have a bit of an identity crisis, to be honest with you, because I consider myself an entrepreneur and an investor first. It just so happens that I know a bunch about accounting and finance stuff, but I was that cliche kid growing up scheming on business ideas, mostly bad business ideas, that my parents got to rein me in on. And so I ended up getting an accounting degree just because I thought it was going to, and a technology degree because I thought the combination would be the best skill set to be an entrepreneur. And then I went sort of in the furthest direction away from entrepreneurship for quite a while, and then came back around and realized really that there's an opportunity to do something different in the CPA space, help people use the strategies that the high net worth folks, you know, it's no surprise that many investors are paying 0 to 20% tax. Big corporations, 25% or less tax. Meanwhile, individuals, 30 to 50%, small business owners, 40 to 60%. If you want to pay 0 to 20%, you have to change your behavior. And most business owners, W-2 earners, don't know how to change their behavior to access those preferential rates. So I saw that opportunity.
That's awesome. That's great. So today we're going to spend a little bit of time talking about that particular opportunity. But just in terms of entrepreneur, what are some of the entrepreneurial things you've done? Tell us a little bit about your own investing as well, just for background.
Yeah, so as I mentioned, I took a weird detour after college. I did a fellowship at the board that writes all the accounting standards in the US. So let me tell you, if you want to imagine the least entrepreneurial environment, go into a group of accountants, PhDs in accounting, and argue about like Oxford commas and all that as it relates to like this accounting standard. So that took me on a whole weird career trajectory for a long time. And as I was sort of in that space and became a CPA and so on and so forth, as being a CPA, you have to get continuing education credits, 120 credit hours every 3 years. And so I thought I would double dip, and I started accumulating real estate brokerage, real estate license credits. So I'd take some real estate classes that would count towards my continuing education. So I got a real estate license about almost 20 years ago now, and started doing a bunch of deals for friends and family, for myself, just sort of on the side. And then that just sort of continued to snowball. And so for the last 20 years or so, I've helped a bunch of friends and family, and built my own portfolio in various times. And then about 11 years ago, I started a CPA firm, and that sort of evolved into this overarching idea of how do I just help people have certainty? Because that's what people seem to really want, which is, it's my belief every action should get you closer to the things that you want. Otherwise, what's the point? And so for many of us, our businesses or our investments aren't actually getting us closer to what we want. And so built this operating system, a community called Certainty U, which is a bunch of digital products, an app called the Certainty app that helps kind of power all this. And so it's just sort of continued to kind of snowball. So on one end, I've done a bunch of real estate investing, other investing, and then built the CPA firm and then some other related businesses around this idea of financial certainty.
That's awesome. Well, cool. So let's get into it then. Based on all the entrepreneurial experience you've got, obviously accounting experience, and you got this breadth of passion to help investors. So, so real estate professional status. Tell us a little bit about what that means by definition, assuming that we have no idea what that is, but we are intrigued by this idea that this designation by IRS allows us to maybe partially, if not wholly, avoid W-2 taxes.
Yeah, so real estate professional status, or REPS, as maybe you've heard it referred to, doesn't have anything to do with having a real estate license, being a broker. It's purely a definition that exists within the tax code. And it's an hours-based definition. And so it says that you need to spend 750 hours in any given year on qualifying real estate activities, which basically is managing your portfolio, managing your properties for all intents and purposes. You need at least 750 hours, and that has to be more than 50% of your working time. So if you have a job where you have 1,000 hours you're working in the job, then you need 1,000.1 hours in real estate to meet the criteria of more than 750 hours and more than 50% of your working time. The reason why we care about that is that once you achieve real estate professional status, then you can take unlimited losses from real estate against any other income that shows up on your 1040. W-2s, stocks, sales, interest, dividends, trusts, K-1s from business activity, so on and so forth. So you can take unlimited losses from real estate against all of your other income. And so it's basically the easiest way. If you said, Dan, what's the fastest path for me to pay zero tax? Which, let me tell you, I work with some of the most conservative clients in the US, some of the most liberal clients in the US. If I put them all in the same room, I'd have no clients because they kill each other. But when they talk to me, they say, everyone tells me I want to pay zero tax. So it's okay, well, the easiest way, fastest path, you or your spouse, if you're married, it only has to be one of you, achieve real estate professional status, because all losses now can offset your income.
So if I'm not married and I have a W-2 income and I'm full-time in my W-2 income, could I claim real estate professional status?
That would be challenging because you have to, it's the more than 50% criteria that TRIPS usually is the thing that prevents people from being able to claim real estate professional status. So if you had full-time, that would be typically 2,080 hours. So then you need another 2,080.1 hours in real estate. The other pathway, though, that we can explore when real estate professional status is not an option is short-term rentals. So that if you can't achieve real estate professional status, the requirements are lower through short-term rentals to get essentially the equivalent benefit. And so oftentimes for that W-2 worker, we look at short-term rentals first. Then as they start offsetting their liability, they start buying more, and then eventually they move to real estate professional status.
Got it. That's great.
Or
So
they marry someone who can. I've had a few clients who weren't married because they thought it was hurting them for tax purposes, and then when they heard about real estate professional status, I can take responsibility for several people ultimately getting married.
There you go. There's a tax benefit to getting married, right? And it could be in the tune of $100,000 worth. So that's awesome.
Well, let me give you an extreme. Last year, I work with a lot of physicians just because they typically are high income earning and they get paid through W-2 income. So I had a couple that make combined about $1.5 million. And so they bought enough real estate in 2020. They offset all of their income, all $1.5 million for 2020. And because of the CARES Act, it allows us to take, for 2020, allowed us to carry back real estate related losses up to 5 years. So they actually offset all of their income for 2020 and the previous 5 years. So they're going to get a couple $1 million back that they paid in from the previous couple years. So I mean, we can go as extreme as you want to go.
That's crazy.
Right.
So,
see, Coco, we're small time still. We got to get to that level too.
Yeah, right. That's just amazing. So Dan, let's just boil it down, maybe making it even more simple for us to understand. How is it that it gets offset? So I'm doing some real estate, and I'm buying some properties. I've got a W-2 job.
Yeah.
I convince my wife, bribe my wife, etc., to tell her, hey, you're gonna start not doing what you're doing, and you're gonna start, doing this material hours. Just kind of as basic as you can make it. How does the tax flow in such a way that you're spending W-2 money to put down as a down payment on a passive income property, and then you're doing this over and over again to get material hours of 750 in a year. So you're driving your car to Home Depot, you're looking at deals, you're evaluating, managing, so you're doing all these hours. How does that tax actually work, and how does it flow in such a way that it can, basically give you tax-free W-2 and then get $2 million back? Like, that just sounds so unrealistic. It doesn't, that's one of those things that if it's too good to be true, it ain't true, right? But it's not true here because it is true.
Well, I don't know if I said this earlier, but the US tax system is inherently fair. And I didn't say good or bad, because that would be a whole other conversation. It's fair in the sense that it's behavior-based, okay? So if you want to access the same deductions and credits as the high net worth, the investor, the big corporation, then you just have to behave in a way that's consistent with the way that they behave. So I mentioned I sort of did this fellowship at the board, and then I went a whole other different direction. The accounting standard I worked on was this derivatives and hedge accounting standard. So I spent basically 10 years helping billionaires make more billions for all intents and purposes. And it was miserable. I didn't enjoy it because it's completely arbitrary. But Bill Gates, Elon Musk, pick your favorite billionaire. They don't wake up on April 15th and go like, oh, I owe some money to the IRS. They've systematically made sure that they have eliminated tax throughout the course of the year. They have a business plan for their taxes. So the reason why it's accomplishable is that you build out the plan, the strategies, you have the documentation, right? And so real estate professional is heavy on the tracking documentation, and it's knowing kind of the nuances of how to do that. So you have to just change your behavior. It's just like investing. It's just like fitness. It's like relationships, finance, tax, same thing, behavior-based, which is why many people, they just don't know about it. They don't know how to change their behavior. But I didn't answer your full, I wax passionate about that, so apologies.
No, I love it.
So how does it actually work? So your 1040, so you guys probably all, you fill out every year this annual 1040. That's really just a reconciliation. It's just showing, it's a summary of all of the different stuff that you did, right? We have a pay-as-you-go system, but we have a bunch of different tax rates, and dividends is taxed different than wages, and so on and so forth. So we have to do this 1040 to just basically summarize what happened and true up, do we pay in enough or not? Right? That's really what the 1040 is. At the end of the day, it's just summary. So on your 1040, you've got all these different types of income, wages, interest income, etc. And then one line item is income from real estate activity. It's a couple more things that go into it. And so if that number is a negative, it can offset everything else that was in your income section. The reason why we can create these negative numbers is because of depreciation, primarily because of depreciation. When you buy a property, on average, and if you do something called a cost segregation study, which is a report, analyze, break up the purchase of the building into these different categories that dictate how long we get to depreciate this property, how many years we get to spend kind of taking this expense. Typically, the cost segregation study allows for us to take a tax deduction of 25 to 30% of the purchase price, right? So imagine, just for simple math, you bought $1 million property, 30%, 300,000. Even if it was a cash flow positive property, right? If you add an on paper $300,000 deduction, you're going to create an on paper loss, right? So that's how it really works, is that we're accelerating depreciation. We're taking this big expense, we take that, now we have a loss that goes against all of our other income on our 1040. And then the real trick is we strategically reallocate what we would have paid in tax to buy more properties. And because we're buying more properties, we make it easier to achieve real estate professional status. We keep doing cost segregation studies. We keep repeating this. And this is how folks will build a massive portfolio over a 5 to 7 year period.
So the key in there is that two items, cost segregation and depreciation.
That's right.
Is really what fuels it. So that's fascinating.
Yeah.
So now if I was somebody who, obviously I want to pay less taxes. I want to use my tax money to buy real estate. I have a spouse that happens to have some time, or I've got a girlfriend or a boyfriend for some folks listening in that I'm going to suddenly ask to marry today. That way tomorrow we can start getting tax savings. How do we get started? Like, do you file something? Do you declare to the universe that I'm suddenly doing this? Or do I need to get an accountant to say, hey, how do I track this? Or obviously behaviors are going to dictate it, like you said. What behavior starts the whole process?
Yeah, so one thing I want to rest assure everyone to begin with is what we're talking about is a pretty evergreen strategy. I'm talking decades that this has been around. So it's not new. And if anything, it typically tends to get more favorable for whatever reason is the tax code, the American dream, I would guess. Real estate is built heavily into the tax code. So this is not an aggressive thing. And because it's been around for a long time, there are a ton of court cases. So the way the process works, maybe this is too much like in the weeds of how the sausage is made, but Congress writes the tax code, and then the IRS interprets it, and they create a bunch of rules and regulations. And then really what happens is that folks take aggressive positions and it goes to tax court. And that's where we really figure out how is this going to work. So real estate professionals have been around for a long time. This has all been duped out in tax court. We know exactly what is good documentation, what's bad documentation. We know how it's going to work and how it's not going to work. And so the way that you declare that you're a real estate professional status is by taking the losses on your return. There's no additional form that you file. Typically on the bottom of page 2 of the 1040, or it's got your name and your occupation. So we would just say real estate professional as your occupation. That's not required. But the way that you make the designation is that you just allow the losses. You say we're allowed to take these losses against other income. It seems weird, but that's the way it works on an annual basis. And then if the IRS were to come calling, IRS audits are at a historical low, but if they were to come calling, then they'd want to see your documentation of your time. Did you meet our requirements? And that's where we look to court cases and all that of how that needs to be documented.
That's awesome. That's beautiful. I'm going to pause here and just see if Troy and Maria have anything you want to add at this juncture, just kind of from your story to Dan's, and then we'll take some of the questions that some folks are dropping in.
Yeah, I mean, I'll just say, I think one of the things, and I just kind of stuck that up there in the chat that Dan just hinted at or talked about, was this, like the logging of the hours. It's all on us to do that. And I think that, there hasn't been necessarily a great system for it. I mean, we created a Google Doc, that can be accessed on a computer or a phone pretty easily. And we try and keep as much detail as possible. For example, we'll have the date, we'll have the start time, the end time, and then I have cells to track, how many hours that is. And then we'll actually describe the activity that we did. So for example, if we drove to our fourplex and we met with a contractor and these are the things we discussed, we'll describe that. We actually have a section in there where it describes like who could serve as a witness to that activity. That's a little difficult, but in that particular example, I would use my contractor's name. And then we would also assign it to a property. So I don't want to get too deep into this unless you want to go there, Dan, but we group our properties. So we group them all together, the hours. And so, one of the cells is, property A, and the next cell is property B, et cetera, depending on what that activity was tracked for. But I think that's probably the most challenging thing, is just making sure that you stay on top of that, because it's easy to kind of get out of hand if, hey, I sent 15 emails today. Well, how much time did I spend actually doing that? And did I log that, in the appropriate system? So
So then this, so it sounds like documentation is an Excel spreadsheet or a Google Doc, or there's no official form out there. So all entrepreneurs out there, there's a job opportunity right there, and a business opportunity is to create a rich people's tracking system to avoid taxes. That's what I will call that spreadsheet. But so you're documenting these hours. What is attributed to the hours? So if I just am up on Redfin, at 11 p.m. at night for an hour, does that count? Driving to a property that I'm thinking about, does that count? Stopping by a property, open house, does that count? So what kind of counts, Troy, that you and Maria have discovered? And then I'll have Dan correct all the things that you counted incorrectly and share with us what we should be counting. So what have you folks counted? Because you got rep status last year, right? And you got $100,000 of taxes written off.
We claimed rep status, right? But we haven't gone through an audit process, and so hopefully that doesn't happen. But because Maria doesn't have or didn't have a W-2 job, right? I think that may or may not kind of induce some flags on the. I don't know that, but anyway, I will say that we probably overtrack. If anything, probably not a really good job of like tracking every single email that we send or every single text message. I think that I've heard or I've read that this contemporaneous log needs to be tracked kind of all in one place. Contemporaneous, if people don't remember, a few weeks ago, we talked about that word. That means like you need to log it as you do it. You can't wait till the end of the year and go back and like try and recall everything that you did around real estate activities. But for example, one of our fourplexes, we'll track every time I talk to the contractor, every time Maria talks to the contractor, every time we go to Home Depot to pick out, fixtures or whatever, anytime I'm browsing Lowe's or wherever I am to like look for, fixtures or paint or anything, anytime I'm talking to the cabinet manufacturer or driving we track all of the distance we drive to. It's 90 miles to home, to the fourplex and back, just as one example. And so if we just have gone there and done some work and then drove back, I'll drop 90 miles into that cell. Now, whether the IRS actually, will accept the mileage or not is different, but we feel it's probably better to overtrack than undertrack. Here's what we've heard we can't track. For example, if we're thinking about buying a property in Mount Vernon and we drive up there and look at 5 properties in Mount Vernon, Washington, and then we never actually purchased a property in Mount Vernon, then those hours do not count against those 750 total hours. And the other thing.
So Jory, just back that one up, because in the process of buying one property, you're going to look at maybe 10 properties. So if you look at 9 properties and you land the 10th property, then the hours from the first 9 in acquisitions and viewing count.
Yeah, we never actually got to that point in a couple of our examples, but that's our understanding. We would probably track that, and then through, if we had to discussions with the IRS, they would determine whether they counted or not, because there's not super clear guidance from what I understand, Dan. It's so we kind of overtrack, but that's understanding. Similarly, like, it's also our understanding when we're running like, cash on cash calculations on properties, let's say in Puyallup where our fourplex is, whether it's that property or other ones, once we've actually purchased one in that market, that type of I call it research. So actually we have a column in our log that it's like, is it property assigned or is it like research and education? So we track that kind of stuff. Like when we served as like, mentors for Kenji and Letty semi-retired community, things like that. And we're mentoring people and kind of coaching them on real estate. We track it in there as just kind of like learning and development, and whether or not it actually counts toward those, toward the 750 total is something that, we don't know for sure, but we're tracking it just to be safe.
So in order to claim the reps, you need to have 750 minimum. So what you're saying is that you're blowing way past 750 just in case.
That's what we're trying to do. Yeah, exactly.
Okay. So Dan, what are they doing? What are they doing wrong?
Sorry, can I add something too? And Dan, correct me if I'm incorrect about this. Even the thinking hours, we were told that we could actually track that hours. And what I mean by that is like, even if you're like designing your own property, you have to go think about it before you can formulate a plan. So we were told that's part of reps because you're actually thinking about on how you actually work on your property somehow. So
Well, that's easy then, because I think about my properties all year long.
I
So
know.
I mean, I'm in the thousands of hours if it comes to that.
Yeah.
So Dan, tell us kind of, obviously, I think they're pretty spot on for my thoughts and experiences with reps. But what would be your official thoughts on that? And I'm going to actually also ask Chris to share a little bit. Chris is another member of our network. He also claims rep status, so it'd be kind of cool to hear his story in a little bit. But Dan, what counts as hours?
Yeah, it's the question that I get asked the most, for sure. And I do think it's advisable to try and track everything possible. There's no downside to having a substantial overage of time, even if some of it doesn't necessarily count. And the time is really supposed to be related to actively managing properties which you own. And so that's why time related to properties you didn't purchase don't count. It's once you purchase them that you can include those hours. So it's time related to management of properties that you own that need to total the 750 hours.
Okay, so time attributed to properties you own. So anything on the acquisition side, research side, evaluation side, analysis side, none of that would technically count, although advisable to track it just for fun.
Well, if you buy the property, then you would include that time.
Okay. So you basically save it up. You save it up. So if you look at 5 properties, then you save, you track it, and then the property you actually buy, you take that chunk of hours attributed to that particular property, and then everything pre-acquisition in terms of time now becomes reps qualified hours.
Yeah.
Interesting.
That's right. But being as detailed as you can and tracking all of the time demonstrates that you are consistently tracking and managing, and you're at. So contemporaneous, Troy mentioned that, contemporaneous documentation, court cases on this. You need to have a consistent method for how you record your time. So the method in which you use doesn't necessarily matter. It's just showing that you have a consistent method. So it could be a notepad, it could be Google Doc, Excel spreadsheet, could be T-sheets, actual time tracking. It's supposed to be contemporaneous, and by the court cases, that means that you recorded your time within 7 days of when you incurred it. So if we incurred time today, then within 7 days, we're supposed to record that in some fashion. But demonstrating that you are actively working at this. So it's not just time that you spent, but it's also showing that we are diligent in tracking it. So the point of that is that when you go into an IRS audit, and again, they're at historical lows, so we really have had a couple people in a decade that have actually gone through it, out of hundreds. You're just giving the IRS something that's as dummy-proof as possible. I don't mean that in a pejorative kind of way, but if we can give them this nice referenced thing that shows that we've been really diligent at tracking things, then and we print it off and we put it, they want everything printed off, but you put it in this nice little binder. Now you've given them something they can just give to their boss, and it's game over, they're moving on.
That's great. Cool. That's awesome. Good stuff. I think anybody else got any questions attributed to hours and qualifying hours or tracking hours?
If not, I can share a couple other things.
Yeah, go for that, and then we'll bounce over to Chris's story in a little bit.
Okay. So the number one thing that folks don't know about, and it may change their decision making on if they were to buy a property or not buy a property, is something called partial dispositions. Partial disposition is kind of this idea that you can't have 2 roofs. Of course, whenever I inevitably say this, somebody will tell me that, well, technically, you could roof over a roof, so you could have 2 roofs. From an accounting perspective, technically, you can only have 1 roof in service being used at any given time. And so the idea of the cost segregation study, and kind of to connect it back to partial dispositions, is you buy a property, and that's one asset, but conceptually it's composed of many assets. A roof is an asset, doors, windows. And so actually one property is composed of many assets. That's why we do this cost segregation study, because we evaluate and put these different assets into buckets, and that dictates when we can claim it. Because one property is composed of many assets, sometimes we dispose of an asset. Like when we tear the roof off, technically we've disposed of an asset. So think about like stocks and bonds. If you buy a stock for $100 and you sell it for 110, you got a $10 gain. But if you sold it for $0, you'd have a $100 loss, right? You bought it for 100, you sold it for 0. That's what happens with these partial disposition scenarios. Is you buy a property, you tear off a roof, and say that roof is worth 10% of the purchase price. So if it's $1 million property, the roof is worth 100 grand, we rip it off. We paid 100 grand for the roof. No one paid us anything, right? No one's buying this roof. It's going to the dump or recycling something. We get to take a $100,000 loss on our tax return for that year. We do not need to be real estate professional status to take that loss. So for many of us, we're buying these properties, if we're doing the BRRRR method, for example, and we're doing a lot of rehabs, it may swing our analysis of whether or not we're going to buy two properties. One of us allows us to take a big on paper loss now. Plus we add back the new roof and we take accelerated depreciation on that. Less than 1% of returns that I look at have the client actually taken their partial disposition losses.
Interesting. Huh. That's
so a little bit in the weeds. Hopefully that wasn't too technical, but the idea is anytime you're doing any major improvements, there's probably an on paper loss that you should be taking.
Yeah, no, that's the fascinating gem, I think, for all of us as investors to keep in mind, is that there are some opportunities that some of us may not be taking advantage of because of that partial disposition piece. That's super, super intriguing. Not everyone's going to find all this fascinating for sure, but this is definitely next level stuff. But it's great because I think it's something that, like you said, a lot of people do not really think through their taxes until about April 15th, and everybody freaks out in retrospect of what they should have done last year. And so I think this is really giving us a chance to look at this year, 2021, and try to get a head start, even though we're already in March. So that's huge on that piece there. I was going to ask you a question, but let me just, let's take a look at Shu's question. How easy is it to achieve reps if your properties are managed by a PM? So meaning that, you know, somebody else is basically doing all the on-site stuff. What would it take to still get reps if you have a PM? Let's say, you know, your properties aren't in the same state you are. Let's say, you know, you're just so busy that you can't really physically get there. What's some ways to get reps, even if you're using a PM or maybe even at a distance?
Yeah, there's a few different moving pieces to this one. And so I'm going to try to not make this overly technical. So you have to achieve real estate. You get the, just because you have real estate professional status doesn't necessarily mean that every property you will be allowed to take a loss on, because you have to materially participate. Now, this is when I start to lose people when we start going through these material. See Troy ready to go take a nap because we've talked about this before. Material participation means basically you've got to maintain decision-making over the properties. So if you just designate all authority to somebody else, then you're no longer materially participating. So it's important.
Definition material, is it material relative to hours, material relative to a percentage of time compared to your PM, or how do you define material?
Yeah, let me, that's technical enough that we should probably on a case-by-case basis talk through it, but I will just tell you that, and Troy alluded to this, and maybe Maria said it as well, you could have properties that you don't materially participate in, or you could have a combination of short-term and short-term rentals and more conventional rental structures, traditional rental, and do something called a grouping election, which is we can treat the properties we're not materially participating in, we can group them with other other properties to get over the hurdle. So folks get really caught up in material participation. If you're actively planning, it's really not that big of a deal as long as your CPA understands things like the grouping election.
Yeah, that's awesome. So then also it could be attributed to purchasing additional properties in the year as well, right? If you have a PM and you need to build the hours, then it's having multiple properties to spread those hours over.
That's right. Yeah. And I do have a document that gives some scenarios and the difference between short-term rental and long-term and material participation that I'd be happy to share out with everyone. It's as plain language as we could make it.
Yeah. Do you happen to have that on you? We can throw that up. I can give you an email address if you want, or you can throw it up in the chat. We can also make it available on our Facebook page. So those of you that are excited about this kind of stuff, which is a handful of us, we'll have it on our Facebook Keiko Exchange page. So if you're wanting to listen to it again or have somebody you know listen to it, some of us have asked on the texts that are coming to me directly is like, I need to get my CPA to meet Dan. So get your CPA to listen to this first, and then if he's interested, then meet Dan. Otherwise, Dan's a great resource, and we bring him in not because we get any kickbacks of any sort, but just as a network of investors. It's great to know some tools and some resources, and Dan's great. So this is awesome, Dan.
I'll email you that document.
Perfect. We'll put that up. Any other questions? Go ahead and just put it up there in the chat. What if I'm a realtor and I'm licensed as a realtor and my spouse has a W-2? As a licensed realtor, could you claim rep status? Since technically in many ways, you're the one who's doing all the real estate in the household?
You would have to have properties that you were materially participating in to get the benefit.
Perfect.
But yes,
yeah. That was the answer that is pretty straightforward. And then Monica's asking, so the property management costs would just follow under business expenses, not hours, but expenses.
Yeah, what you're paying your PM would be a tax deduction that would be a tax deduction. The hours that you might spend managing the PMs for specific properties would count towards your hours for a real estate professional.
Yeah. And what about the hours if I need to go look up appliances or go to Home Depot for a property I own, even though I have a PM?
Yeah, I would count those hours.
Yeah.
The real thing is once you get to 10 doors, you should have your own property management company in addition to whatever property management company you hire to add in some other deductions like the Augusta loophole.
The which loophole?
It's called the Augusta loophole. Yeah, so the thing is,
I haven't heard that one. I'm going to write it down. What is that?
No, there's like when I said there were 10 parts to the strategy or 11 or whatever, I wasn't lying.
But Troy, we're almost up to you having to open up your own property management company, bro.
Yeah, almost. Maybe
faster. This flywheel that I was describing, which is, as you have more properties, then back to sort of the like Bill Gates, Elon Musk example, they have a business plan for their taxes. They don't wake up on April 15th, but there's also trigger points. So we've got the current structure, and then what is the trigger point when that structure changes or when we add more stuff? So say, for example, we have the rental properties and our spouse is the real estate professional. They're not working other than that. At some point, we set up this property management company so we can charge a fee to our rentals. And we're just doing that to create a different category of income. So then we can use that to pay our kids, do the Augusta loophole, allow our spouse, if they wanted to contribute to tax deferred retirement accounts. And so basically we're just skimming more income off the rental properties and then reallocating it to some other deductions that wouldn't typically qualify under the real estate category.
That's awesome.
There's just sort of layers, and you just keep, and over time, as you have more, it becomes easier and easier to pay no tax. Yeah.
That's really cool. How do you spell that? AGUSTA loophole?
Yeah, Augusta, like Augusta, Georgia. It's also sometimes referred to as the Masters loophole. But yeah, I'll drop it in the Augusta loophole.
Perfect. Oh, okay, you're gonna beat me to it. Perfect. Because I'm just guessing.
You can Google it. There's tens of thousands of articles on it. So it's something that's been around for more than 20 years. I learned about it in college.
Yeah, no, that's super fascinating. Cool on that one. And then let's see, the question is, if you don't meet reps this year, but plan on doing so next year, is there an advantage to waiting until next year to do a cost segregation study?
Yes, wait.
So let's just back it up real quick. You mentioned cost segregation. I skipped over it earlier just because, I mean, I know what it is, and I think a few of us know what it is, but this is such a powerful, I think a lot of people don't know what it is. And so this is attributed for those of you who are either thinking about buying a passive income property or have already purchased one this year, and you're looking at maximizing your depreciation write-off. This is pretty huge, and especially when it comes with the costs associated with year one acquisition. So tell us a little bit about how this works and what we should be thinking about when it comes to the year of acquisition. And then what it costs to do a cost segregation, because we can't really do it on our own. It's not something that we just go and write it up. We actually have to hire somebody. So tell us how all that whole system works.
Yeah, so the concept of the cost segregation study is this, again, this idea that one property is really composed of many different assets, roofs, doors, windows, infrastructure, HVAC, etc. And so you conceptually bought many assets when you buy a property. And the relevance of that is within the tax code, depending on the type of asset dictates the depreciation schedule. So some things are 3-year, you take the expense over 3 years, some are 5, 7, all the way up to 39 years. And so it's, if you just bought a property by default and it's residential, you take it over 27.5 years. If it's commercial, it's 39. So just by default, you've got a really long period of time to take that expense. So you do the cost segregation study to go, hey, most of this, or some of this should not be over 29. Some of it should be over 3 years, 5 years, 7 years. And because it is 3-year, 5-year, et cetera property, that qualifies for what's called bonus depreciation or accelerated depreciation. And we could just take it all this year. And so why is this the way that it is? Well, these are arbitrary rules. You can't necessarily logic your way into this. It's just the way the rules have been written. Moral of the story, though, is you do the cost segregation study so that you can, instead of doing it over 27.5 years or 39, you can do some of the purchase price over a shorter period of time and potentially over 1 year. And so that allows us basically, typically, to claim somewhere around 25% of the purchase price. So back of hand, if you said, I'm going to make $1 million of W-2 income this year, how much real estate should I buy? Take that number times 4, and 4 million, that's probably going to generate, easily enough tax loss to offset all of it. And so that requires you to hire a qualified engineering firm, basically a third party that comes out and writes up this study, does this analysis of your property to allocate it across these different buckets. They have fancy company names like Cost Segregation Studies, LLC, and a bunch of other various versions of cost segregation study. They have probably the smallest marketing branding budget of any service provider out there because they all have these very on the nose names.
Yeah.
Troy, you've done some recently. Usually you want to be in a group where you know other people so you can pool it together and get the benefit of having 10 doors done at once. So that drives the cost down quite a bit because they do travel out to your location.
Yeah, just one comment on that. I mean, this is related to kind of two things that came up. So we did, last tax year, 2 tax years ago, whatever it was, we did 3 cost segregation studies, one on a property that we acquired in the year that we did the study. And then we did 2 other cost segregation studies on properties that we had acquired like 10 or 15 or 20 years ago, right? So we've been claiming depreciation over the course of all of those tax years. So we couldn't get as much out of that cost segregation study as we would if we did it in the year we acquired it. But there's still depreciation expense there that we were able to claim. And so even after the cost of the cost segregation study, we still came out in the positive for that. For those houses that we held on for, much longer, it wasn't as much. But I think for those three, just for context, it was a fourplex, a single family home, and a condo, and the cost was around $8,000 for all three studies.
Yeah, it's not cheap, but it's it more than pays for itself
Yeah.
in regards to the return.
And
investment.
and I should say too, yeah, thanks for mentioning that, Kakoa, is that, you know, they'll quickly, most of these companies will give you kind of like a free assessment to determine, you know, kind of what your cost basis is, what they think your approximate offset might be. And then you just look at the numbers and say, okay, they're going to charge me, you know, $3,500 for this one study on this one property, but they think I'm going to be able to offset, you know, whatever, 30,000, 100,000 in income. So you just do the math. It's pretty straightforward.
Yeah, perfect. Good stuff. Chris, anything you would add for reps, since I know that you and your wife are also doing the reps?
Yeah, the only thing is the regular, they told us the only thing we can count is what we do normally in our regular line of business. So as a property manager, you're not buying units. So that's not my regular, believe it or not, even though we manage units. So looking at properties, they said, no, we're not going to count that. But all the maintenance that we do, all the traveling to and from for maintenance, or, you know, any disputes, they count that. But as luckily I have the development side, anything to do with the development, talking to engineers, talking to planning, zoning, going to the city, all that is counted. And trust me, here in
That's
Honolulu,
1,000 hours by itself.
yes. So that's the lucky break for me.
Yeah.
But
awesome.
you just have to make sure that you kind of have that as part of your business model, is development or rehab. That way you have a reason to go to DPP and talk, and then document all that, because that is a lot of headache.
And so are you the W-2, or is your wife the W-2?
Yes. So I'm a full-time W-2 still, unfortunately, but my wife just picked up full-time, so she's always been the part-time. She's the one that's doing all the work.
So she's reps.
Not anymore. Not 2020. She just got full time, so we're no longer going to be able to count that. 2021, I should say.
Gotcha. All right. So Dan, question in the chat: if I'm a GP or an LP, so a general partner or a limited partner in a syndication, since syndications are becoming a big deal, can I count those hours for reps, or how could I count those hours? How would I materially participate in a syndication?
Yeah, generally speaking, the general partner is probably materially participating. Limited partners probably not. So the way you potentially could include it is if you did a grouping election. So you group this investment with other real estate investments that you're actively participating in. Usually probably don't want to do that with syndications for other reasons, but probably the direction that you would go. I did also get a question from Maria that I think was just a direct message to me that had to do with, I think is the question, Maria, just to confirm, is it about how you allocate between land versus building for calculating depreciation?
Yes, that's actually for an investor that couldn't make it today. So I know this is recorded, so she's going to go watch this again.
Yeah, so I sort of made the comment that if you buy a $1 million property, then typically you can claim 25 to 30% of the purchase price, which is a true statement. But what I didn't say is that not all of your purchase price is depreciable. Part of your purchase price gets allocated to land, and land is not a depreciable asset. So you're supposed to use a ordinary, reasonable method for calculating the amount of building versus land. The conventional approach has been to use the property tax records to see what they list as the ratio between building and land, building improvements in land, and apply that ratio to your purchase price. you know, the historical data says that the IRS doesn't challenge anything that has a allocation of improvements of more than 80% or less. So you could generally make a blanket statement that you're just going to assign 20% of your purchase prices to land.
Thanks, Dan.
That's awesome. Well, cool. Oh, and then somebody wanted to know, Shu wants to know about counting rep hours with hard money lending.
As in you're the hard money lender?
As in you're the hard money
Probably
lender?
not.
Okay. What if you're a hard money lender and then somehow you were a partner in or a material participant in the property that you're investing in or lending on?
Yeah, the time in and of itself for hard money lending would not count. You would need time related to actively managing rental properties. So you could have any business, not just hard money lending, as long as you also had properties that you were actively participating in.
Yeah, that's awesome. Good stuff. Well, hey, we're going kind of long, which is great. It just means that the topic's super fascinating for us. Dan, can you drop your email, phone number, and other information in the chat that you're willing to provide? So that way those who may have additional questions are able to give you a call. This has been super, super interesting and of course, fascinating because most of us definitely want to try to figure out how to minimize taxes. Anybody else got any final questions for Dan or Troy, Maria, or Chris, just relative to real estate professional status? Dan, we could do a whole nother conversation on cost segregation one day and the Augusta loophole.
Sure. Yeah.
That whole idea of hiring your kids and having them write off stuff is fascinating too, right?
Yeah, I mean, you cannot take a tax deduction for buying your kids food or clothes or anything like that. But if you paid your kids for up to $12,000 per year for meaningful work, that would be a tax deduction. And then they could take that money and buy their clothes or food. So indirectly, you can get a tax deduction that way. Or they could put $6,000 per year in a Roth. If they did that from the age of 7 to the age of 18, at retirement age, that would roughly be 8 million. If you got an average, it would grow to from compound interest if you got an average rate of return of 9.8%. So, I mean, there's just so much that you can leverage.
So you could put a $6,000 a year into a Roth on behalf of your kids through your company. So then you're also getting a write-off, which is also compounding to $8 million. Did I hear that right?
You pay your kids, you take the tax deduction for it.
Yeah.
They now have what's called earned income, which is a requirement for you to be able to contribute to a retirement account. So then now they have earned income. The standard deduction is $12,000 right now. So if you paid them $12,000, they would apply the standard deduction. They'd have zero taxable income. So you get the tax deduction. They don't pay any tax. And because they would have earned income, they would be allowed to put in the maximum Roth amount, which is $6,000 per year. So if you did that every year, starting at the age of 7 to 18, you just put $6,000 a year in. You just did that up till 18, and then they just kept it invested in like just boring S&P 500. You run the compound interest on that, it turns into about 8 million at retirement age.
And how many years is that roughly?
Well, from 7 to 18, so you got 12 years that you make the contributions, and then it's just sitting in there. And so then when they turn 65, basically inflation, all that. So how much it actually contributes, but it turns into a significant number. Plus you got the tax deduction.
Right. Interesting.
So it's a legacy play.
Yeah. Yeah. That's super cool. And I mean, that's $500 a month, which we all spend on our kids, minimum that amount. Right. So
right.
Yeah, all these cool opportunities. Well, we could
really like $300 a month because maybe you're in the 40% tax rate, so you get 40% back on that payment.
I see.
So if you really, if you really want to teach your kids about finance and stuff, you get them on payroll, and then it goes into their account, and then you can show them, explain to them how much their food costs and their clothes costs and all that they're paying with their own debit card. I mean, this is like getting more advanced and not necessarily for everybody, but indirectly it's a way to get a tax deduction.
That's awesome. And how young can they be for you to pay them?
Well, if they're doing like modeling type stuff, they can be any age. Most states, though, if they're doing like admin type work for you, then it falls under the family business rules. And so typically 7 and up.
7 years old. Wow. That's awesome. Blaze is asking, what you do this through primary state or another state? I'm not sure I understand the question. Hey, Blaze, try clarify your question a little bit.
Sorry, I'm not sure.
Sorry about that. Quick typing. Would you do this through the state you live in, or would you do that through a more tax advantage state, or what state would you use to, I guess, how would you pay them out specifically?
Yeah, you would have to pay it in the state in which you live.
Gotcha. So that's Hawaii. Yeah, Blaze, you live in Hawaii. Gotcha. So that's Hawaii. And then Tammy's asking, Dan, you know of any self-directed 401 complaint companies?
I do, and I'm blanking on the name. There's one here in Seattle area. I'll have to get back to you, but yeah, I do.
Perfect. When you get it back to us, maybe just shoot it over to my email and then we can throw it up into the Facebook page. Perfect. This is great. Yeah, I mean, we could go on and on. I mean, we should do a whole segment someday, Dan, on tax hacks.
For sure. Yeah, no, that would be fun. Guidant Financial.
Guidant Financial. Guidant Financial.
Yeah.
Perfect.
In the chat.
Hey, thanks so much, Dan, for jumping on. It was such great information. And I think it's very important for everybody in the group because, like, as entrepreneurs, we're usually like big thinkers, visionary dreamers, you know, and we forget that that's just like the beginning, right? Like the whole part of running a successful business and company. It's like you forget about, like, you have to have the infrastructure set up in the company, and that includes tax strategies, tax planning, bookkeeping, accounting, right? So this is all still very important information, even whatever venture you're in, but especially real estate, right? Since there's so many tax advantages. So thank you for sharing and coming on.
Yeah, no, my pleasure. Super passionate about this. Always happy to discuss it. And yeah, we work so hard to earn our money, and then in the back end, you know, for some of us, we pay back 40% of it. So if you could even keep half of that, think about the impact long term.
Yeah, that's huge.
Hey, Dan, one last question. Are you still accepting clients?
I'm a capitalist pig, so I'm always accepting clients.
That's the best answer I've heard.
That's awesome. I love it. I love the transparency. Well, truth be told, we're all capitalist pigs. That's why we're all on here. We're all trying to figure out ways to get sharper, get smarter, and it's a great session today. Thank you, Dan, for taking the time. Troy, Maria, as well. Chris, for your input, and everybody else for jumping in on this Friday, first weekend of March. Isn't that crazy? 1 year since COVID started. Here we are, the fastest, longest year in history. And Dan, you gotta. I'm going to talk to you some more about that. That whole CARES Act tax in reverse deduction thing, where you get money back. That's what is that? Is that CARES Act 2?
That was the CARES Act from middle of last year. Yeah, it's called NOL carryback. Put it in the chat.
NOL.
Operating loss. Historically, it has not been allowable for real estate losses, but the CARES Act made it allowable.
And so could you do that in 20? Could you claim it? So this year we're filing for 2020. So that would still apply then.
Yeah, that's right.
So everybody look up NOL carryback on Google and figure out if you can go get the IRS to cut you a check for $2 million like that other guy.
Yeah, if you really can't sleep tonight, reading about NOL carryback is the perfect hack for that.
That or the Augusta loophole, or just some really exciting things.
That's right.
Hey, Dan, really appreciate it. If you're available towards the end of April and want to come out to Hawaii, we'd love for you to be a part of that mastermind, and we can have you share all these cool tax hacks as well as part of that conversation.
That would be awesome.
Yeah, well, great. Well, thanks everybody.
Thanks,
For
everyone.
those of you who need to go, feel free to go. We're going to hang out for just a couple of minutes. Dan, we know you're on a time clock here, so thanks so much for being with us. And we really appreciate it. And for everybody else, thanks for being on as well. And Corey, nice hair job today.
I rolled out of bed, just put the hat on.
I know you.
I was stuck in traffic on the H3 for